Self-assessment. What is it?
Most people are paid through PAYE, which means that their employer or pension provider deducts tax on behalf of HMRC, and also means that they usually won't have to complete a self-assessment tax return. If someone isn't paid through PAYE or has additional income not taxed through PAYE, then they would need to account for this through self-assessment. Self-assessment is used to report income and capital gains to HMRC, or to claim tax allowances against a tax bill by completing a tax return either online or in paper form. HMRC then uses the information supplied to calculate the tax bill. The reason it's called self-assessment is not because you decide how much tax to pay, but because you are responsible for making sure you provide the correct information.
So how does self-assessment affect me?
Self-assessment applies to everyone who has sent a tax return. Common examples are self-employed people including business partners, company directors, other people with more complicated tax affairs including people who pay higher tax rate, pensioners with more complex tax affairs, people who received rent or other income from land and property in the UK.
What records should I keep?
You should keep any documents relating to income received through employment. For example, Part 1A of any P45s received, end of year certificate P60, details of taxable expenses and non-cash benefits, pay slips and pay statements, certificates of any tax award schemes, and information relating to redundancy or termination pay.
So what other records do I need to keep?
If you have any other income from any other sources, you should keep those documents also. Sources of other income include benefits, pensions, interest and dividends, income from property, foreign income or gains, income from employee share schemes or share-related benefits, capital gains or capital losses, and income from self-employment.
So what are the tax return and payment deadlines?
Shortly after the start of the new tax year, the 6th of April, HMRC sends a tax return or notice to complete a tax return for the previous tax year to everyone who normally completes one. These are some key dates to remember. The 31st of January. This is the formal deadline for returning any tax return. There's an automatic £100 penalty if this is missed. This is also the deadline for paying the balance of any tax you owe. The 28th of February. If you don't pay the tax bill balance by the 31st of January, you'll be charged an automatic 5% surcharge on top of the amount still owing, in addition to any interest payments. The 31st of July. If you still owe tax that you were due to pay by the previous 31st of January, you'll be charged a second automatic 5% surcharge.